BWS continues to brief you on financial facts, market signals, and wealth ideas. Welcome to our weekly deep dive for the week ending March 7th, 2026.
The U.S. stock market just endured its most brutal week since last year. Volatility wasn't just high, it was systemic. The S&P 500 shed 2% to close at 6740. The Nasdaq dropped 1.2%, and the Dow Jones Industrial Average plummeted 3%, ending near 47,500. This marks a significant technical breakdown for the Dow.
The fundamental driver was a geopolitical explosion in the Middle East. Military actions led to disruptions in the Persian Gulf, a critical artery for global energy. Consequently, crude oil prices surged past $90 per barrel, a staggering 35% weekly gain that sent shockwaves through the global supply chain.
Then came the Black Friday labor data. The February non-farm payrolls arrived as a negative print, a rare and terrifying sight. With the unemployment rate climbing to 4.4%, the narrative of a soft landing evaporated instantly, replaced by the ghost of the 1970s, stagflation.
Trading volume spiked as panic selling accelerated during the latter half of the week. Investors are realizing the Fed is trapped. They must fight energy-driven inflation while facing a weakening economy. Risk-off sentiment is no longer a whisper. It is a roar across all asset classes.
The Federal Reserve maintains its restrictive stance, keeping rates between 3.5% and 3.75%. Despite political pressure from the Trump administration, Chair Jerome Powell remains firm on central bank independence. He emphasizes that while the economy is moderating, inflation remains far too stubborn for rate cuts.
Quantitative tightening continues unabated. There is no sign of QE returning to save the market. In fact, the recent oil spike has only reinforced the hawkish lean within the FOMC. Markets now price in only 1 or 2 rate cuts for all of 2026. Likely not before the summer.
The Middle East conflict is the ultimate black swan for energy. Shipping routes in the Persian Gulf are the focal point. If Iran's involvement deepens, we aren't just looking at $90 oil. We are looking at a structural energy crisis that could redefine the Fed's entire terminal rate path.
Let's look at the canary in the coal mine signals. The Shiller PE ratio is now at 39.18, sitting in the 99th percentile of historical data. This is extreme, approaching levels seen only before the 1999 dot-com crash. Valuations are stretched to their absolute limits as risks mount.
Margin debt is another red flag. As of January 2026, it reached $1.28 trillion, or roughly 3.8% of U.S. nominal GDP. While not past the 2021 peak of 3.97%, it shows that investors are effectively all in, leaving very little dry powder to buy this dip.
The VIX, or fear gauge, exploded by over 24% this week, hitting 29.49. This level suggests deep-seated anxiety. Meanwhile, gold has surged to the 5,160 range per ounce, reflecting a massive flight to safety as traditional equity bond correlations break down under inflation stress.
Interestingly, credit markets remain strangely calm. The high-yield option-adjusted spread sits at 3%, well below the historical average of 5.2%. This divergence between fearful equities and optimistic credit is a key tension. If credit spreads begin to widen sharply, that will be the signal for a true collapse.
Within sectors, the energy ETF XLE was the lone winner, benefiting from the crude rally. Paradoxically, the Nasdaq was more resilient than the Dow, falling only 1.2%. This is thanks to the AI theme, which continues to act as a localized buffer against the broader macro storm.
First, the data deluge. Monday brings consumer inflation expectations, followed by the highly anticipated CPI and PPI updates midweek. If these numbers come in hot, the stagflation narrative becomes the consensus, likely forcing another leg down in equities.
Second, Fed communication. While there is no formal meeting, the rumor mill regarding Powell's potential successor, like Kevin Warsh, will be active. Any hawkish commentary regarding the high oil prices will be treated as a sell signal by algorithmic traders.
Third, oil price continuation. The conflict with Iran shows no signs of de-escalation. If supply disruptions persist, energy-driven inflation will dominate the Fed's decision-making process, overriding any concerns about the weakening labor market.
Fourth, the gossip and heavy hitters. Watch for Cathie Wood's comments on AI opportunities during this dip, and whether Michael Burry doubles down on his bearish outlook. Also, any indirect pressure from Trump on the Fed could trigger unexpected currency volatility.
Finally, the Q1 earnings warm-up. While the Magnificent Seven are quiet, mid-cap names like HP and 3D Systems report next week. These results will test if corporate demand is actually holding up or if the macro pressure is finally breaking the bottom line.
The market is currently a battle between high leverage and geopolitical reality. The 20% point in B-roll should remind us, the picture can change in an instant. Risk balance for next week remains tilted heavily to the downside unless we see a sudden softening in energy prices.
In conclusion, the week's decline was a toxic mix of an energy crisis and labor fragility. High trading volume indicates this wasn't just a ripple, but a structural adjustment. Stay focused on the 10-year Treasury yield and those credit spreads. They are your final guardians.
This has been BWS, your briefing on financial facts, market signals, and wealth ideas. Stay measured, stay informed, and we will see you next week.
Thanks for watching. Please subscribe to our channel for your weekly financial briefing. See you next time.